So when people talk about the gold rush, the cliche you always hear is, don't mind the gold, sell the shovels.
Right, yeah.
It's clean, it makes sense, and it's comforting. But when you look at the current computing landscape, that shovel analogy just falls wildly short.
Oh, completely.
We aren't just looking at a company selling shovels. I mean, we are looking at an entity that somehow owns the only shovel factory on Earth, and they dictate the exact technique every miner must use to dig.
Yeah.
And on top of that, they own the roads the miners take to get to the mountain. We are looking at NVIDIA, and trying to calculate the actual structural reality of a monopoly like this requires looking way past the daily hype cycle. But before we get into the weeds, I have some required reading here. To access more advanced researches, follow Guru's latest movement tab, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store. To track stock market temperature, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Links in the description. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions. Okay, let's unpack this.
Yeah. A good place to start the unpacking is with a fundamental reset of what this business actually is today.
Right.
Because public perception is severely lagging the corporate reality. Like, a large portion of the market still views NVIDIA strictly through the lens of a chip supplier.
You mean like the graphics cards you slot into a PC?
Exactly, the ones used to render hyper-realistic video games.
Which, that used to be their core identity.
It did, but looking at the historical data sets across the last decade, gaming is now hovering around just 9% of their revenue.
Wow, just 9%.
Yeah, the other 85 to 90% is entirely driven by the data center.
Okay, but here's what I want to push on with that. Selling chips to a data center instead of a teenager in their basement playing games, it doesn't seem like enough to explain a valuation in the trillions.
Well, it wouldn't be if they were only selling the chips. The pivotal shift, what's fascinating here, is that they have transformed into an end-to-end data center systems architecture provider.
Okay, architecture provider.
Right. They are no longer just handing a tech giant a tray of advanced GPUs like the Hopper or the new Blackwell chips and just wishing them luck. They are selling the entire nervous system.
But wait, selling the network cables along with the chips doesn't sound like a revolutionary pivot. Like, why does controlling the networking infrastructure matter so much?
It comes down to the actual physics of how artificial intelligence is trained today.
Okay.
When a company is training a massive AI model, they aren't using one chip. They are linking tens of thousands of GPUs together.
Wow, tens of thousands.
Yeah, and these chips have to constantly talk to each other. They are sharing pieces of the neural network back and forth in fractions of a second.
I see.
So if the network connecting those chips is slow, it literally doesn't matter how fast the individual GPU is.
Because it's just sitting there waiting.
Exactly. A $40,000 processor will literally sit idle waiting for data to arrive.
Okay, so NVIDIA realized that third-party network bottlenecks were basically making their expensive chips look slow.
Precisely. So to solve this data starvation problem, they just developed their own networking infrastructure, things like Quantum InfiniBand and Spectrum X Ethernet.
Oh, I've heard of InfiniBand.
Yeah, they engineered the communication pathways to be optimized specifically for their own silicon. And that networking component alone is now pulling in multi-billion-dollar annualized run rates.
That's incredible.
Yeah, they control the brain computing the data and the nervous system transmitting it.
Right. But controlling the physical hardware is one thing. The layer that seems to make them practically untouchable, at least from what I'm reading, is the software.
Oh, absolutely.
Because people throw the word moat around constantly in finance, to describe a competitive advantage.
Yeah.
But NVIDIA's software platform, CDA, it just seems to operate on a completely different level.
It does. CDA is arguably the most powerful asset they possess. Even more than the physical silicon designs. It is the invisible glue holding their entire monopoly together.
The way I was visualizing this while going through the research today is that CDA is essentially the English language of the AI world.
That's a great way to put it.
Like, imagine if every single developer, researcher, and data scientist on Earth has spent the last 2 decades writing their code and communicating exclusively in English.
Right.
And now a competitor comes along and says, hey, I have this brand new, slightly cheaper hardware you can run your programs on.
Yeah.
But the only catch is you have to translate your entire life's work into a brand new language you've never spoken before.
Yeah, and very few developers are going to take that deal. You are describing the exact mechanics of switching costs.
Right.
Over the past 20 years, millions of developers have built highly optimized, globally shared software libraries specifically for the CUDA platform.
Because it's the only game in town.
Exactly. So when you try to take code written for CUDA and run it on a rival chip, say from AMD or Intel, it doesn't just work natively.
You have to run it through a translator.
Right, and translation introduces friction. And in the computing world, that friction is known as overhead. It slows the execution time down. So if you are a massive tech company spending billions of dollars on hardware, and your goal is to be the fastest to train a new AI model, you really cannot afford software translation overhead.
Because time is money.
Huge amounts of money. The slight discount you might get on a competitor's chip is entirely wiped out by the drop in performance, plus the labor cost of rewriting your code.
Wow. Okay, so they own the language of AI, they own the computing brains, and they own the nervous system connecting them.
Yes.
And that monopoly-like dominance is, it is aggressively reflected in the financial data we have here.
Very aggressively.
Yeah, like in fiscal year 2016, their revenue was sitting around $5 billion. Fast forward to fiscal year 2025, and that revenue has exploded past $125 billion.
It's hard to even wrap your head around that scale of growth.
It really is. But here is the mechanism I don't fully grasp. If they are constantly inventing these complex multi-die architectures and engineering advanced data center systems, shouldn't their capital expenditures and operating costs be skyrocketing right alongside their revenue?
You would think so, yeah.
How are they extracting so much actual profit out of this physical hardware?
Well, the secret lies in the structure of the fabless business model.
Fabulous.
Right. NVIDIA designs the chips, they architect the systems, and they write the software. But they do not physically manufacture the silicon wafers themselves.
Oh, I see.
Yeah, they outsource the actual physical fabrication primarily to the Taiwan Semiconductor Manufacturing Company, or TSMC.
So they basically get to skip building the giant billion-dollar fabrication plants.
Exactly,
Yeah.
which completely insulates them from heavy depreciation.
Right.
Manufacturing semiconductors requires buying lithography machines that cost hundreds of millions of dollars each. By letting TSMC carry the burden of buying those machines and building those factories, NVIDIA keeps their balance sheet incredibly light.
That is wild.
Depreciation expenses currently sit at less than 5% of their gross profit.
Oh, wow. So it's basically like they write the recipe and they pay someone else to buy the ovens.
That's exactly it.
Yeah.
And because the market is absolutely desperate for their specific recipe, NVIDIA has total pricing power.
Right.
When you combine that high pricing power with an outsourced asset-light manufacturing base, your profit margins naturally expand to staggering levels when demand spikes.
And the demand spike is historic, right?
Oh, definitely.
Looking at the sheet, net income growth hit 581% in fiscal year 2024,
Yeah.
followed by another 128% growth in fiscal year 2025. And those margins you mentioned, they have stabilized around 74 to 75%,
Which is just crazy.
retaining 75 cents of gross profit for every dollar of physical hardware you sell is virtually unheard of in the tech hardware space.
It is. It has generated over $60 billion in free cash flow, creating a fortress balance sheet where their current assets cover their liabilities by more than 4 times.
So near-term solvency is practically a non-issue with that much cash generation?
Not an issue at all.
Yeah.
They're deploying it into aggressive share buybacks and tactical dividends. Financially, the engine is running flawlessly.
But retaining 75 cents on every dollar is spectacular for NVIDIA, while in capitalism, a 75% margin is basically a giant target on your back.
Oh, for sure. Everyone wants a piece of that.
It practically begs your customers and competitors to find a cheaper way to operate, because no moat is entirely invincible.
Right.
So if we look at the structural vulnerabilities in the research, the headwinds seem to split into 2 distinct realities. Things that challenge them today and things that could permanently fracture the business over the next decade. Let's start with the immediate physical bottlenecks.
Okay, so the most pressing short-term physical bottleneck is memory supply.
Memory supply.
Yeah. We discussed how standard networking cables starve the GPUs of data, right?
Right.
Well, the same physics apply to the memory on the chip itself. To feed the GPU fast enough, NVIDIA relies on high bandwidth memory, or HBM.
Okay, so standard memory is like a single-lane highway, so they need a multi-lane highway.
Better yet, imagine stacking standard memory chips vertically, like floors in a skyscraper,
Oh, okay.
and placing that skyscraper mere millimeters away from the computing core. By doing that, you drastically shorten the physical distance the electrical signals have to travel.
I see. So it's all about distance.
Yes, it allows massive amounts of data to flow simultaneously. But manufacturing that stack HBM is incredibly difficult.
I imagine.
And NVIDIA relies entirely on a very small pool of suppliers like SK Hynix and Micron to build it. If those suppliers hit a production snag, NVIDIA literally cannot ship their completed GPUs.
Wow. So they are totally dependent on someone else's factory for that, too.
Exactly.
Then there is the issue of just keeping the hardware from melting, right?
Oh yeah, thermals.
The thermal dynamics of these new Blackwell chips are pushing the limits of data center infrastructure.
They are, because the computing density is so incredibly high, just blowing cold air across the servers no longer works.
Right. It's like trying to cool down an oven with a desk fan.
That is exactly what it is. So the industry is being forced to transition to rack-scale liquid cooling.
Liquid cooling.
Water or specialized fluids are pumped directly to the chips to absorb the thermal density.
But piping liquid through data centers full of electrical equipment, I mean, that introduces severe engineering challenges.
Oh, massive. You have leak risks, massive yield tuning issues. As NVIDIA tries to ramp up production on these liquid-cooled systems, any engineering hiccups directly delay their revenue.
Right. And even if they build them perfectly, there is the lingering threat of a hyperscaler CapEx digestion period, right?
Yes, the digestion period.
Because the hyperscalers, Google, Amazon, Microsoft, Meta,
Yeah.
they have been front-loading their capital expenditures.
Big time.
Spending tens of billions on NVIDIA chips out of fear. It is essentially an arms race. They are terrified of missing the AI wave.
But eventually, all that capital expenditure must be justified by actual consumer demand and software revenue.
Right. They have to actually make money off these models.
Exactly. If these T1 cloud providers realize they have purchased more computing power than they can immediately monetize, they will pause their orders to digest the inventory they already have.
Oh,
A sudden 12 to 18-month pause in purchasing from just 3 or 4 major companies would cause NVIDIA's revenue to drop significantly.
that makes total sense. So those are the near-term cyclical threats. But let's look at the existential threats.
Okay.
The permanent structural risks that could cap their growth entirely. The first one is a matter of global policy.
Right.
The U.S. Department of Commerce has implemented stringent export controls on high-performance compute silicon.
Yes.
And this directly targets shipments to China and adjacent markets.
And looking at this purely from a mathematical and business reality, setting aside any political philosophy, these restrictions represent a permanent curtailment of their total addressable market.
Right. Because a large chunk of the globe is simply off limits for their highest margin, most advanced products.
It just creates an artificial ceiling on their customer base. You can't sell to them, period.
Right.
But the second long-term structural risk goes back to the very fabulous model that makes them so profitable today.
The foundry concentration.
Yes.
It's like running the most highly sought-after, wildly profitable restaurant in the world. But you rely on exactly one farm for all your ingredients, which is TSMC in Taiwan.
Right.
If that farm has a bad harvest, an earthquake, or a geopolitical disruption, your restaurant has absolutely nothing to serve, no matter how many people are lined up at the door.
That single geography reliance is the glaring vulnerability of the fabulous model. But we need to take that analogy a step further. Not only are you relying on one single farm, but some of your biggest customers, the hyperscalers eating at your restaurant every night,
Right.
they are actively building their own kitchens in the back.
Oh, man, the custom ASICs?
Yes.
Google's TPU, Amazon's Trainium, Microsoft's Maya, the very companies driving NVIDIA's $125 billion revenue are aggressively trying to replace them.
And they are doing it because of that 75% gross margin we talked about earlier.
They want that margin for themselves.
Exactly. Google and Amazon don't want to pay the NVIDIA premium forever, so they are designing application-specific integrated circuits, or ASICs.
ASICs.
Yeah, a GPU is a generalist. It is incredibly powerful because it can do almost anything. An ASIC is a specialist.
Okay.
So if Google just needs to run one highly specific search algorithm or recommendation engine, they don't need the broad flexibility of an NVIDIA GPU.
I see.
They can design an ASIC that only does that one specific task, which ends up being significantly cheaper to produce and consumes far less power.
Wow. So if the hyperscalers successfully migrate their internal workloads to their own custom silicon, NVIDIA loses its biggest buyers.
That's the threat.
So we have an incredibly wide software moat and flawless current financials, but it's balanced against a vulnerable physical supply chain, capped global markets, and customers who are actively plotting to become competitors.
It's a lot to weigh.
It is.
Right.
So how do you possibly put a price tag on a business in that situation?
Well, you apply a strict valuation framework.
Okay.
And if we run NVIDIA through traditional Benjamin Graham value investing criteria, the dashboard flashes bright red immediately.
Right, because the metrics that value investors have used for decades just break down here.
They do.
I mean, the price to earnings or PE ratio frequently sits above 35.
Yeah.
The price to book ratio is also astronomically high. Traditional value investing looks for a PE under 15, demanding that you pay a low price for current earnings.
Right.
So by those strict historical standards, the stock is wildly overpriced.
It is. However, a purely historical lens ignores growth. Okay. And that is why it passes the Peter Lynch PEG ratio.
The PEG ratio.
Yeah, the PEG ratio takes that high PE multiple and divides it by the earnings growth rate.
Right.
Because NVIDIA's earnings have been growing at triple-digit percentages, the PEG ratio drops below 1.
Oh, I see.
So the sheer velocity of their growth mathematically justifies the high multiple in the short term. Furthermore, they are generating a return on invested capital, or ROIC, of over 65%.
Meaning they are incredibly efficient with the cash they do keep.
Exactly, proving that every dollar they retain is deployed with brutal efficiency.
But the true test of intrinsic value is the discounted cash flow model, the DCF, right?
Always.
Because we are trying to figure out exactly what one share of this company is actually worth based on the cash it will produce in the future.
Right.
So the deep value research here runs 3 different DCF scenarios based on a starting free cash flow of $60 billion. And they use a 10% discount rate, which essentially accounts for the opportunity cost and the risk of holding the stock versus a safe asset. Let's walk through what these models actually assume.
Okay, so the first scenario is the zero growth case.
Okay.
This models a reality where NVIDIA's cash flows flatline today. They never innovate another breakthrough, and they just maintain that $60 billion annually in perpetuity.
Okay.
Under that strict mathematical constraint, the intrinsic value of the stock calculates to $33.36 per share.
Which is a baseline floor.
Exactly.
No one actually expects zero growth.
No.
What does the second scenario, the conservative case, assume about the world?
So the conservative case models a cyclical mean reversion.
Mean reversion.
Yeah. This represents a world where the hyperscalers do exactly what we discussed. They realize they overbuilt and they pause their orders.
On the digestion period.
Right. The model assumes a 15% drop in cash flow next year as the industry digests its inventory, remaining flat in year 2, and then slowly recovering with 10% growth in years 3 through 5.
Okay.
Under this highly conservative cyclical assumption, the intrinsic value is $36.02.
Wow. Okay. So even with a recovery built in, the intrinsic value only moves up slightly because those initial down years destroy so much compounded value.
That's the math.
Now, give me the absolute bull case. What happens if the AI infrastructure build-out continues uninterrupted?
That is scenario 3, the nominal case of sustained expansion.
Okay.
This assumes 25% annual cash flow growth for the next 2 years, decelerating slightly to 15% for years 3 and 4, and 10% in year 5.
That is massive growth.
It is. And if you run those aggressive uninterrupted growth numbers through the DCF, the intrinsic value jumps to $70.91 per share.
And this is where the math really collides with market psychology.
Yeah, it is.
Because according to the data, the stock is trading in the public markets well above $120.
Yep.
So even in the absolute rosiest uninterrupted growth scenario we just ran, the intrinsic value only reaches around $71.
That's right.
And take that a step further. A strict value investor doesn't just buy at intrinsic value.
Right, you need a buffer.
They demand a margin of safety, usually around 30%, to protect their capital in case their assumptions are wrong. So if you apply a 30% margin of safety to that best case $70.91 scenario, your actual buy target is roughly $49.64.
Which perfectly illustrates the value investor's dilemma here.
Yeah.
The underlying business is a structural marvel. The operating metrics are spectacular. But the public market price, that 120-plus figure, it demands absolute perfection.
Leaves no room for error.
Exactly. It prices in not just the hypergrowth we've already seen, but a future of continuous, uninterrupted dominance that frankly defies the gravity of traditional valuation models.
The market has just stripped away any cushion.
Yeah.
I mean, if HBM memory yields drop, or if liquid cooling pipes leak in a major data center,
Right.
or if Amazon scales up its custom Trainium chips faster than expected, the current stock price has no structural support to absorb that bad news.
None. For an investor requiring capital protection relative to structural earnings power, the conclusion from the data is quite stark.
What is it?
You would basically have to sit on your hands and wait for a severe broad market cyclical pullback to enter the stock safely. You are looking at a fundamentally flawless business carrying an immense amount of expectation risk.
So to synthesize this entire architecture for a second,
Okay.
NVIDIA has successfully navigated the most lucrative pivot in tech history, moving from video game graphics to becoming the undisputed architect of the modern AI data center. Their financial metrics display unprecedented scaling, and they are protected by a software language in CEA that the entire world is literally forced to speak.
Yeah.
Yet they remain heavily bound by the physical constraints of planet Earth, relying on a single island for fabrication, specific suppliers for stacked memory, and the literal thermodynamics of keeping the silicon from melting.
It's quite the paradox.
It is. And they are priced at a premium that assumes none of those physical risks will ever materialize.
Yeah, they are operating at the absolute bleeding edge of human engineering, but they are ultimately subject to the unforgiving laws of financial mathematics.
Which leaves me with one final thought to ponder here.
What's that?
We've established that NVIDIA's deepest moat, their stickiest asset by far, is the CEA software ecosystem.
Hmm.
But their biggest bottlenecks, Taiwan, HBM memory, liquid cooling, they are entirely physical.
Right.
So at what point does the immense value of the software completely detach from the hardware?
Oh, that's interesting.
If the entire globe is natively speaking the language of AI, could that language eventually outgrow the very silicon it was built to run on?
Wow. That tension between software dominance and physical constraints, that is going to define the next decade of computing.
Something to think about the next time you hear a new AI announcement. Thanks for joining us on this deep dive. We'll see you next time.